Hello, everyone, and welcome to the 7th episode of JustDario Cigar Time. So what are we going to talk today? Of course, like one of the most popular topic at the moment. And don't worry, it's not going to be NVIDIA because at the moment I am quite tired of it, personally speaking. But it's going to be Bitcoin. But a very specific part of what's happening, and that's where the title of this new podcast comes from. Wall Street Bitcoin Takeover. So why Wall Street is taking over Bitcoin? Not all crypto, but specifically Bitcoin at this stage. I'm not saying that what I'm gonna describe to you today is not gonna happen for other tokens and other crypto assets in the future. But it's very important to understand what's happening today in order not to get lost, fall into mistake, fall into fear of missing out and other things that are gonna happen for sure if you just take all the nonsense narrative that is being put out there without the right tools to understand what makes sense, what doesn't make sense, how things really are, and how they can develop. So a very important thing to understand today in this toolkit that I'm happy to give to you today to understand this market dynamic is Wall Street asset managers' psychology, okay? Everyone think that Wall Street asset manager wakes up early in the morning, read research as complex algorithm, incredible strategy, and whatever. Very few of them do fit this description. 99% of them don't. From active fund, passive fund, pension fund, insurance fund, and whatever, what everyone does. And if you ask them directly, of course, they will not admit it because, everyone needs to make his job fancy. But what everyone does is effectively follow a benchmark, okay? Why do they follow a benchmark? Okay. A benchmark is useful for them because you can compare the fund performance to it by definition. If you outperform, you can charge extra fees. If you downperform the benchmark, usually it's due to whatever excuse they may come up with. But more often than not, it might be due to the management fees themselves and the trading fees that they need to account for to follow this benchmark. And then, of course, benchmarking, portfolio allocation, and whatever is needed to cover the asset manager ass, right? You have all these offering documents that no one reads, okay? But basically, in these offering documents, it's already described down to the very details what the asset manager can do, what he cannot do, and what's the margin of discretion he has. And let's be honest, once an offering document is set and the strategy is set, they don't have much margin of discretion, okay? Furthermore, if they use this margin of discretion, let's say I want to overweight this stock in the benchmark instead of the other, and they underperform the benchmark, then they get screwed by their bosses, they might lose their bonuses and so on. So it's better to stay around the tracking error of the benchmark than taking the risk of outperforming it because it's not going to change your life. And frankly speaking, you are paid to manage money. You are not paid to make money. That's another thing that people need to understand very well. You guys think that asset managers out there, they're paid to make you money? Of course not. They are employed by the asset management firm, the insurance firm, pension funds, and whatever, okay? So, of course, their first priority is to keep their job. Now, if the market crashes and their fund crash along with the market, are they going to get blamed? No, going to keep their job. If the market goes up and their fund goes up, but let's say a little bit less, okay, will they be blamed? A little bit, but you know what? In a bull market, everyone is happy. They will still get their bonus, okay? But if they underperform the market significantly, or, remember that Wall Street people, they always compare one to the other. They love league table. If they end up at the very bottom of this league table for the underperformances, even in a bull market, they get sacked. Now, if everyone is following the same benchmark, okay, how do you get to the very bottom of this league table? You need to use discretion and you screw up. Is it worth it? Of course not. So at the end of the day, everyone on Wall Street, they can use all their fancy words, all the strategy, whatever. Everyone is in the same boat, okay? Tracking the S&P 500, having multi-strategy allocation, blah, blah, blah. They all copy each other, okay? I mean, creating a fund is one of those businesses that have pretty much no barrier to entry, besides legal fees and some other paperwork that for this just corporation is peanuts, right? So everyone is pretty much doing the same thing. The real difference between them is their fundraising network and capabilities, okay? So the more money they manage, the higher their management fees, their pay, and so on. Okay, so let's have this concept very clear in your mind. Everyone on Wall Street is on the same boat, right? Now, how do you differentiate yourself if everyone is the same, right? You need to get your hands on the new thing, on something that people cannot get their hands on for whatever reason. Like, as I said, restriction in the offering documents, restriction on regulation, and whatnot. Okay. Now, why people on Wall Street want to buy crypto, even if most of them still cannot do it, but they want to buy it. Okay. Because point number one, that gives them a new narrative, new edge to stand out compared to their competitors. Okay. It gives them access to an asset class that has a huge potential to grow. I mean, Bitcoin right now is worth less than Apple. What are the probabilities that Bitcoin has a higher growth than Apple in the next year? I mean, it doesn't take a crazy mathematician to figure this out, right? And remember, like, Wall Street always reasons in terms of expectations and growth, okay? So everyone wants to put their hands on the next big new thing that has the highest growth potential, okay? So what do these people start to do? These people start to look for alternatives because, of course, they, as we said, they cannot buy it. What can be an alternative? Imagine you are managing a portfolio of stocks, okay? And, you have your benchmark and everything, but you, as you said, you need to attract more asset under management in your fund. So how can you differentiate your pitch compared to someone else? I have exposure to crypto, right? How do you get exposure to crypto? You buy one stock that effectively allows you to do that almost with, well, now not anymore, but almost at that time with one-on-one correlation. The stock was MicroStrategy, okay? So everyone now criticizes Michael Saylor, what he's doing and whatnot. Is he crazy? Make MicroStrategy in a massive bubble. I mean, I'm not saying I disagree with any of these things, even if to some personally, they don't make much sense, objectively speaking. But let's be honest. If someone, comes to you with money on a silver plate, okay, $10,000, and asks to buy whatever, the widget you're holding in your hands, and that for whatever reason, they're not willing to go to the shop and buy for the same price, but they want it from you, and that widget is worth $5,000. Would you not give it to them and just take the money and go back to the shop and buy another widget and put $5,000 of profit in your pocket? Of course you will do. Let's be honest. Now, this is what's happening to MicroStrategy to make it easy. I try to explain on my post. It was a bit complex, but I try to make it easy, okay? So bear in mind this example I just gave you, okay? So you have Michael Saylor on one side, and you don't have only one person in line. You have 1,000 people in line, okay? So remember, Michael Saylor is not selling his own Bitcoin of MicroStrategy. He's taking the money and go in the market, buy more Bitcoin and put it in the trash, okay? So you have all these people in line, okay? And none of them can buy Bitcoin, but all of them, they have plenty of money, okay? So their only access, their only bottleneck to that specific risk exposure is MicroStrategy because it's a stock, okay? They are stock managers, okay? So, and then these people are not only in line. Let's add one more detail, okay? Who offers more can jump the line and ride on top, okay? So there is a little bit of game theory here, okay? So what's going on here? People are paying a premium to access a specific asset class, okay? It's not that different from when you want to buy the ticket of a concert, but it's only available in the secondary market, and you have to pay a premium. Taylor Swift tickets, oh my God, $7,000, $20,000 US, so on. Why are they paying 10 times the price? It's exactly the same reason. At the end of the day, is the rule of demand and supply. So this guy, as Michael Saylor, as the stock, so yes, the supply has the stock of MicroStrategy. And on the other side, there is all this demand for his stock because they want to get exposure to crypto and pitch it to their clients to attract more AUM because their fund, their strategy, or whatever is different, has all this growth potential, projections, or whatever. This is always the Wall Street game, expectation, growth, and whatever, okay? So they buy a premium. Now, MicroStrategy is a business that is now almost irrelevant to its Bitcoin assets, okay? So till there are people willing to pay such a premium to have exposure to Bitcoin, okay? Why MicroStrategy shouldn't continue to do that, right? They're like, give me your stocks, buy Bitcoin, I pay you X, and then some person behind him shouts, I pay you 2X, I pay you 3X, okay? He's like, okay, guys, I issue shares, I take the money, I buy more Bitcoin. There you go. And the price keeps going up. People are like, oh, he's diluting himself and whatever. From certain perspective, this is true, okay? But from another perspective, as you can see, the price of MicroStrategy keeps going up, okay? And is becoming richer and richer on paper, although he cashed out a bit before, so he will remain billionaire eventually, even if things go wrong. So what's the game here? Those who paid, let's say, 10% premium gets exposure to Bitcoin. Bitcoin keeps going up. And the people behind them, they're like, shit, I should have paid that 10% premium. I really need to get exposure. I pay 15% premium. Get me in this time. MicroStrategy buys more Bitcoin, okay? Bitcoin goes up. The people that didn't pay the premium are like, oh my God, look at those guys. They're doing so well. Their funds are outperforming me. They're attracting so many AUM because they have the exposure. I don't have. I was an idiot. My boss is kicking my butt. I'll pay 20% premium. And on and on and on. And MicroStrategy doesn't only issue shares. They also issue convertible bonds. Why? Because some asset managers or insurances might not be able to buy stocks, but they can buy bonds to keep things easy. And fun fact, Allianz, an insurance, bought 25% of the last convertible bond that MicroStrategy offered, okay, to the market, that they needed to upsize it for such an overwhelming demand to like 2 billion and something, what they wanted to offer just $1 billion, okay, at 0% interest. What is a convertible bond? It's basically a bond with a call option, okay? So at the end of the day, to keep things simple, is not that much different from issuing shares, okay? The type of exposure that you get is very similar. And in theory, you have a downward protection. And then, of course, The conversion ratio is not exactly 101 because it's a bond, there is the dough that's out there. But to keep things simple, you have all these people that keep bringing in money on a silver plate. They are stampeding one on top of the other, and they're asking him, just buy Bitcoin for me. I don't care about your business. I want to have this exposure. And he can continue doing what is he doing, okay? Because all these people that are supposed to be institutional professional investors are having such a fear of missing out that is them to blame for creating and allowing this nonsense to continue. Now, people are like, what's going to happen if, the premium of MicroStrategy goes negative, right? I mean, what happens if it goes negative? It's very easy. MicroStrategy, okay, can simply arbitrage the market, sell a little bit of Bitcoin, and buy back his own share to close the premium, okay? Or hedge funds can do that on their behalf. Like, it's an arbitrage, right? So basically, this is why Michael Saylor is saying, I'm selling optionality. He's selling a call option, but it's not a standard call option, of course. Basically, the strike price, let's say, is the price of Bitcoin, okay? And then gives these people the exposure to the upside of Bitcoin, an exposure they don't have. That's effectively is an option. So is selling call option. So effectively is selling volatility, okay? So, and basically, like, if Bitcoin goes down, okay, but it still holds the assets, then the arbitrages will kick in, okay? So, of course, it's not a standard option. So maybe that's why people are thinking that it's crazy, that's the same bullshit. No, it's what he's saying is completely correct, is that very few people are understanding it. He's taking advantage of it, and the investment banker that are helping him, they're having a hell of a payday. The problem is that those professional institutional investors that are supposed to understand this are not understanding it, and because of behavioral biases, they are creating bubble, right? But the bubble is not on Bitcoin. The bubble is on MicroStrategy stock. But MicroStrategy stock, again, is not going to crash below the Bitcoin price. Simply arbitrages will take over if the premium goes negative, right? Furthermore, now we have the Bitcoin ETF that has been the most successful ETF launch ever. I really do not get why no one is saying this. It's been the most successful launch ever. Like, asset managers were fighting against each other to be the first to get there. And they were fighting so hard to get these ETFs approved because, I tell you, there is demand out there. All this demand for MicroStrategy stock, a lot of people could buy an ETF, like private wealth manager, like other pension funds can buy ETF and so on, okay? So, and as a matter of fact, like now the Bitcoin ETF for BlackRock, for example, is even bigger than the gold ETF, right? Again, it's a very, very straightforward Wall Street game here. So Bitcoin ETF broadens the market, right? So it gives more people, retail and institutional, but in particular retail, to access Bitcoin. People are saying, oh, but retail could buy Bitcoin before. Yeah, they could. But have you ever tried to buy Bitcoin for real? I mean, I'm not saying in an exchange, okay? I am a crypto purist, okay? Try to buy a Bitcoin or to mine a Bitcoin and then have it, in your wallet outside an exchange. It's freaking, difficult, okay? And then if it is a Bitcoin bought on an exchange rather than an ETF, it has different taxation regimes. It has different legal regime. It has different succession regime and so on. So long story short, many people stayed outside Bitcoin simply because they didn't want to deal with crypto exchanges. They didn't want to deal with direct. I mean, it's such a pain in the ass. We go to the spot ETF because before there were like the synthetic ETF, whatever, usual garbage, synthetic my ass. There's nothing to do with Bitcoin. Okay, now you have the Bitcoin ETF, the spot one. Be clear. Here we go, right? So if we put what I'm saying now to what I said before about MicroStrategy, now you have demand from Bitcoin to come up. You have MicroStrategy that keeps buying Bitcoin. Okay. Imagine that MicroStrategy stops buying Bitcoin, okay, because the premium becomes negative. You still have the buying pressure from the ETF sides, from the crypto world and whatever. And that will hold the floor on MicroStrategy stock. That's exactly the play. So what the regulator should do here, or if all these people want to buy Bitcoin, crypto and whatever, Wall Street buys garbage so much, like CDO, or like synthetic here, synthetic there and whatever. Why not Bitcoin, right? I mean, because of course there are other considerations and whatnot, but, they will surely broaden, the landscape for people to directly buy Bitcoin and avoiding middlemen and avoiding exactly these situations that are happening. But it will take time, okay? So, do you understand now all this Wall Street fear of missing out? There's no retail. It's Wall Street. Then, that is Wall Street managing retail people money. So, eventually, still is retail money, but they just don't know it. Or maybe, they don't pay that much attention, or maybe they're happy because they're performing. So, when things go well, everyone is happy. When things go bad, they still get their paycheck. You get the losses. But, so, they're still happy. You will not happy. So, you have all this Wall Street fear of missing out. And then, boom, you have Bitcoin spot ETF options that starts trading. I mean, first of all, spot Bitcoin ETF options are very different from cash settled options. Okay? Cash settled options are, to put things simple, not that very different from gambling. Okay? You can create a position synthetically, whatever, but it's not that much different. It's like half of a future, let's say. Okay? And you can put strikes here and there, you can play around, but it's not the real thing. Okay? You are gambling on the real thing. It's not different from poly market. Okay? If you want to hedge an asset with cash settle option, that's gonna suck, right? Because you cannot post, in particular when you cannot post that asset like Bitcoin as a collateral. So that's why like options on CBOE, cash settle option on crypto, they never took off. But now the story is different. Now you have spot options. And I tell you, like Wall Street loves these options so much and loves to sell them and make money out of them. Why? Because gamma squeezing has been the most popular and profitable trade for years now, like beyond any like honest risk parameter and whatever. Like people are talking about MicroStrategy. Oh, look at the premium, it's such a bubble. They only have 30 million of Bitcoin and they are worth 100 billion market cap, whatever. Like, guys, what are you talking about? People are buying stocks that trade at 50 times their sales, more than 300 times price earnings. Is it not the same thing? Are they not buying a massive premium for the business? So why that happens? It's because of it's magic word, gamma squeezing. They love it because can never go wrong in a market where you have all this Wall Street asset manager that's supposed to be sophisticated and whatever. In reality, it's a huge crowd of passive investors. So in reality, what really trades of the asset per se in the market, it's not that much, even if the volumes look big. In reality, it's like these market makers, exchanging between themselves the same share, okay? So the float in reality is limited, okay? So just keep buying out of the money call options and you will make money. The problem is that when they will stop buying it, then at that time, the shit will hit the fan. But what's happening to, Bitcoin now, at the end of the day, is what has been happening for years in the stock market. So, then people say, Bitcoin is it's not money, whatever. We already touched upon this, guys. Can you go to the supermarket with a bar of gold? No. They would not accept for payments. Can you go with silver? No. They will not accept it for payments. Can you go with a bag of coffee? Can you go with, platinum? Can you go with, any whatever commodity that you cannot print out of thin air and then purchase something else? Not really, right? We live in the world of fiat money at the end of the day. And effectively is the amount of fiat money value that people gives to a certain type of thing. You can have all the tools you want. As I said before, even myself, I wasn't understanding Bitcoin for a while. But then when people give value to something, and this something, it trades against different fiat currencies that, they don't really have much value themselves left, right? Because they keep printing them out of thin air. You cannot print Bitcoin out of thin air. You can print gold out of thin air. So effectively it becomes a store of fiat money value, a measure of fiat money value that you can exchange for a currency to another, and will always remain the same. 1 bar of gold is 1 bar of gold. 1 Bitcoin is 1 Bitcoin. 1 ounce of silver is 1 ounce of silver. The price that fluctuates in as measured in fiat money. And as we discussed, if at the denominator you have a limited supply asset like Bitcoin or gold, and at the numerator you have fiat money and they keep printing liquidity like crazy and government deficits and whatnot, the price in fiat currency is always going to go up by definition. I mean, it's a simple formula. So, gold was considered worthless for the Latin American population before the arrival of the Spanish. At the end of the day, after thousands of years, they conformized themselves to assigning a store of value to that gold bar because it was recognized by everyone. It could be exchanged in different countries for the whatever, like local currency, and enable trade. Why Bitcoin is any different? It's digital, okay? So people, Bitcoin doesn't exist. How many of the people that invest in gold, they really have a gold bar? They ever touched a gold coin or whatever? I'm not talking about jewels, okay? That's bullshit. That's not investment, okay? That's such a massive markup. You're paying for a design. You're not investing in gold. How many people ever saw a stock certificate? How many people hold a bond in their hands, okay, like a real bond? Everything is digital, guys. We are evolving. As you know, I personally own both Bitcoin and gold because it makes sense in this highly inflationary environment, okay? And I personally think gold will remain simply because it has been there for 2,000 years, 3,000 years. So it's imprinted in the human DNA. But telling me that Bitcoin has no value because you cannot touch it or it's digital, then what happens when you pay with a credit card? Are you touching the cash? No. How many of you have cash in their pockets nowadays? If they have to print cash banknotes for the equivalent of the money they are printing out of thin air in the monetary system, it will be so expensive that the price of paper would be through the roof, and we have no forests because they have to kill them, right, to print all those banknotes, right? And then, climate change and pollution, whatever. Imagine that. It sounds ridiculous, right? Because it is. So, to summarize, we are having a Wall Street fear of missing out. We are having an asset class that is the one that right now has the highest expectations for growth potential. We are starting to have the instrument to enable the legacy investment strategies onto this new asset class, and in particular to enable the most favorite play that Wall Street loved in the past few years. This was gamma squeezing. And gamma squeezing works so well for asset management because their asset under management increase. They can earn more management fees and everyone is happy. So why to stop the party when everyone is having fun, right? I will leave you guys with this question today. Thank you for listening to me. Happy to have your support, to subscribe to this channel, follow me on X, on Instagram. Feel free to reach out to me for feedbacks. I have my forum on JustDario.com where you can ask me questions directly, where also my blog where I publish my daily article. And I wish everyone happy Sunday and talk soon.